the community.
Hey, Equity
Hi, I
Mate.
just had a question.
Hey, Bryce,
Hey,
friend.
Bryce and Ray.
I've got a question.
Answered.
So today's question comes from Darcy. A reminder, if you want to submit a question, you can head to equitymates.com/contact. But let's have a listen.
Hey boys, love the show. Hey, I was wondering if you could talk about stocks and tax and how capital gains tax is calculated, whether you've held stocks for a year or not, and come tax time, how you keep a record of your winners and your losers so that next year it's not such a burden. It sounds simple when you talk about it, but when you open that MyGov app, it quickly gets confusing. Thanks.
Nice. Thank you so much for the question, Darcy. And yes, no doubt that this is a time of confusion for a lot of investors when they hit tax time, especially if it's your first time giving it a crack. So
My number one tax tip: never sell.
yes, I was thinking that. Yeah, there's
You
a
don't have to deal with
Yeah,
it.
that's it. Don't sell. Don't have to worry about it. Now, first we should start with actually how capital gains tax is calculated.
Yes.
Firstly, to Ren's point, it's only calculated if you sell. That's when you have to worry about it. And there's two elements to it. If you hold your investments for less than 12 months, it is considered a short-term gain. It is added to your assessable income and taxed at your marginal tax rate. The full capital gains that you make is added to your assessable income. If you hold it for more than 12 months, this is where you're then eligible for the 50% discount on the capital gains, which is then added to your assessable income at your marginal tax rate.
So to be clear, 50% of the gain is added to your assessable income.
Yes. Yeah.
Now, for people who are not in Australia, this may be confusing because if we go over to the States, for example, there is a separate tax rate for capital gains. That is not the case in Australia. There is not like a 20% tax rate for capital gains. Rather, the gain that you make is added to your overall assessable income alongside your salary and any dividends you got paid and any rental income if you have an investment property. It all gets rolled up into your assessable income. And then the difference with capital gains is that 50% discount if you held the asset for longer than a year.
Yeah. So it really comes down to the 12-month time period. That's where you kick in the 50% discount. Now, it's up to you to record all of this information and either plug it in as you do it yourself or go through with your accountant.
Well, hold on. I think, it is up. The responsibility is on you. The good thing is with brokers these days, they have a transaction of every time you've bought and sell and the date and time you did it. So there is that data being recorded if you're using an online broker.
Yeah. So the second part of your question, Darcy, is around how do you keep track of all of this, winners and losers, so that it doesn't become such a burden. Firstly, if you provide your tax file number to your broker platforms, it does plug into MyGov, and the ATO does or can pre-fill a lot of information. Now, it's not always entirely accurate. You do need to validate it, and it doesn't necessarily cover all the transactions that you've made, but it is a good place to start. Ren, how do you go about this? If you are selling, how do you go about tracking and doing this at tax time?
So to be clear, the not selling was a joke.
Yes.
Yeah. Let's just make that very clear. So I use the information from my broker, and I also have a spreadsheet where I track everything. But honestly, like the information from my broker is enough.
Yeah. So I guess there's information in your broker. Get the spreadsheet out. What you really need to be recording is just purchase date and price, and then at which point you sell it, what your sale price is.
The complexity really comes, I find, if you are choosing to, like, if you've been dollar cost averaging over time, and then you are selling portions of a holding over time. That gets complicated. Is it first in, first out? Is it last in, first out? Like all of how long did I hold each parcel for? That's when it gets complex. But I find that like I don't really trim my portfolio in that way. Like if I'm selling, it's because I don't believe in something anymore. And so then I'm selling the whole amount. And so then that's a little bit easier to do the maths on.
So a couple of platforms that I think I would certainly recommend if you want to take away some of the burden at tax time is Sharesight. I use it, highly recommend it. You do have to track during the year all of the purchases and sales that you make, but come tax time, they spit out tax reports for you that you can just use in MyGov or for your tax accountant. So yeah, it can be complex, but I think doing the work throughout the year to keep track of it is the way to go. But I think the main thing here is the capital gains tax, the 12-month period, and it's not a separate rate. It is just applicable to your accessible income.
A few other tips just as we close it out. Make sure you record your capital losses as well, because they offset future gains in future years. So to explain that, we say that if you hold an asset for a year, you get that 50% discount, and so you only add 50% to your accessible income. Well, you can also add less than 50% to your accessible income if you've also claimed losses in previous years that offset some of those gains. So that's a good one to keep in mind. You mentioned Sharesight. What you didn't mention is that there's an offer for Equity Mates listeners. If they want to sign up and get a discount, they can go to they can go to sharesight.com.au/equitymates.
Yes, yeah, we'll check that out. It is free to get started if you have less.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.